Hi everyone. Let's take a moment and look at how we would determine the bond proceeds, which involves determining the present value of a bond. Okay, the problem appears in front of you, and it's a little small and perhaps hard to read, so let me read it out loud. If we issue $1,000 face value bonds with a stated interest rate at 10% paid annually, that will mature in 5 years when the market rates of the bonds are going for 12%, what entry would we make to record the bond proceeds in the issuance of the bonds? And to come up with that entry, I've indicated that we should use Excel's present value function to solve for this one. Okay, let me show how we would do that. First, let me bring a couple things to light, and I've solved this one ahead of time, so just to save time in the demo. So what we need to know is we need to answer a series of questions. Okay, that'll eventually get us to determine the present value. Okay, first we need to know the face value of the bonds, and that's $1,000, right? And the face of the proceeds would then be equal to 100,000. Okay, now I'm sorry, I missed one up top here. The number of bonds. There's 100 bonds, $1,000 each. So if we multiply those two, and you see I'm just multiplying C7 times C8, the values in cell C7 times C8, we come up with the face value of the proceeds. Okay, then the stated interest rate is 10%, so we can compute the payments by multiplying the face value of the proceeds times the stated rate, right? C9 times C10, we come up with $10,000. All right, the number of periods is 5. They're annual bonds, and the maturity length is 5 years, and then the market rate is 12%. Okay, now we need to compute the present value, and let me hit the F2, or actually let me call this up and walk you through it. So I'm using Excel's present value function. Okay, so we enter the rate, and that comes from cell C13, which is 12%. Let me move this where I think you can see it. I think that's better. Okay, so C13 gives us the rate we use. We use the market rate. The number of periods is 5, coming from C12. We make the payment negative just so the answer comes back in positive. Keep in mind that present value and future value functions, as well as how a calculator works, whether we're using Excel or a calculator, assumes that outflows appear as negative and inflows appear as positive. So if we're issuing the bond, we would have to give up the $10,000 payments and then give up the $100,000 in the future. That's why they're negative here. And then the type we can leave blank because the payments are made at the end. And the future value is the $100,000. So given all that information, I'm going to slide this up. We can just hit OK, and it calculates a present value of $92,790. All right, let me see if I can put the entry down that what we would make. Let me bring these in black. We'll make debits and credit. I haven't worked this part ahead of time, but let's just do this. We would debit cash, the proceeds, equal to the $92,790, right? We would record bonds payable. I'm going to indent that just a little bit, of equal to 100,000. This would be the entry. And of course, we've got to record that discount, which makes up the difference. So if I take the 100,000 times the 92,000, or minus the 92,790 cash proceeds, I'm going to get a debit that should go to the discount on bonds. Okay, and our textbook may call this something else. Let me expand this a little bit so we can read it. But I'm just going to call it for now bond discounts. Let me bring this back so we can actually see this. Get a little bit bigger, and that's probably fine. Okay, so there's our entry. Our debits equal our credits. We've recorded how that occurs. Now, just to prove that this actually worked right, I want to drop in an amortization schedule that I've worked ahead. So here's our bond discount amortization schedule. Okay, couple things. We would drop in the carrying value of the bond. So I'm going to have to make this a little bit bigger here. Let me shrink this column so you can see all of that. I think you can see that. So at the issuance date, and then we'll show the amortization. We've got the 7210, which is essentially 100,000 minus G20. And G20 I just took from the cell C15, the present value of the bonds. Okay, and then we would determine the payments, and the payments comes from top 10,000, so that's always the same, right? Now the interest expense at 12% we would calculate by taking the 12%, I've locked it in with dollar signs, D19 times the carrying value from the beginning of the year. That's how you'd calculate the interest expense. Okay, once we have that, then you can easily determine the bond amortization by taking the interest expense minus the payment, and that difference represents the bond discount amortization. Well, once we have that, then we can calculate the carrying value of the bond at the end of the year by taking the previous balance appearing in cell F20 and subtracting off the amount we're amortizing for this period, right? And of course, once we know what the ending bond discount is, then we can determine the carrying value by taking the previous carrying value amount and adding the dollar amount of the bond amortization. Remember, with a discount, the carrying value of the bonds will go up over time. With a premium, the carrying value will go down. Okay, once we have that, we can simply copy this cell. Let me just format that down, copy the formulas down, and what you see is by the end of the year, the bond discount goes away to 0, and the carrying value of the bonds go to 100,000. Okay, that's just a brief look at how you would use Excel's present value to determine the proceeds of a bond issuance, how you'd make the entry, and how you could put an amortization schedule to help you make the periodic entries that you'll need to make to record interest expense. Thanks, everyone.